Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video update that we do here each and every night, where we go over all of our opening trades as well as our closing or adjusting trades. So I gotta say that I finally got back into the Thinkorswim platform this afternoon, so that was great, and I apologize so much for not sending out the video on Friday or over the weekend because I just couldn't even access anything until Thinkorswim opened up their offices. And come to find out, they just don't have a lot of support for Macs. But once you go Mac, I guess you never go back. So we will go over all of the trades that we made on Friday last week for those of you who are members and were signed up on Friday. Those of you who are new members, I know we had a lot over the weekend and a ton over or Monday morning here that we're going to go over those on Friday, and then also the new trades, which are designated by this Monday right here. So we only had two new trades today for Monday, and then one closing trade that we'll go over. The first trade I actually want to go over, I want to skip over MS, which is Morgan Stanley, and I want to talk about Tesla. Now, Tesla actually came up on one of our coaching sessions and has come up a number of times, actually, and just like the logic and the philosophy behind implied volatility versus implied volatility rank, percentile, whatever you want to call it. So I want to go over this trade first because I think it might be a little bit confusing, and maybe this will shed some light on the differences between them. So in Tesla on Friday, and these are all Friday trades, so all of the top four here on the opening side, all Friday opening trades. We had no closing trades on Friday. So for Tesla, what we did is we bought a vertical for May, and we bought the 210-215 call spread. So that's about a $5 wide spread, and we want to pay about the mid price. And in this case, we paid a little bit under the mid price, or about $240 for that spread per spread that we bought. So it was about a $500 investment that we made in Tesla. And it's basically a 50-50 bet. But the first question I got after I sent out that alert, not only on the coaching session that I had just the other night, but also I got a lot of emails about this as well, is that everyone said, Kirk, Tesla's implied volatility is up in this, up around 60%. So if Tesla's implied volatility is up around 60%, why aren't we selling a credit spread? Why aren't we selling an iron condor or a strangle or a straddle or something like that? Why aren't we selling options instead of buying options? And the easy answer to that is that, yes, Tesla's implied volatility is at 65% today. Today is at 65%. And I've actually, on the chart of Tesla here, down in the bottom section, that is Tesla's exact implied volatility every day as long as you can go back. But here's the thing. 65% may or may not be high for Tesla. So we always have to look, is Tesla's implied volatility, which is right now at 65%, low or high historically going back? And so that's what this IV rank does in the top left-hand corner of your screen. So IV rank right now is saying, okay, Tesla's implied volatility, even though the exact down to the number figure is 65%, is actually in the 29th percentile, 1 to 100%, the 29th percentile of its historical range going back a year. So now you can visually see this when I throw this chart up, because if I take Tesla here and just kind of draw a line back all the way back over the past kind of 9 months here, you can see that, yeah, you're right. There have been numerous times when Tesla's implied volatility has been up around 70, 80%. That's the high implied volatility that we want to be selling Tesla in. So it's different when you look at options as regard to a stock like Tesla, because high implied volatility in Tesla could be 80%. Versus something else like Apple or Chipotle. That stock may have implied volatility around 60 or 20 or 10, but that 10 or 20 or 60 may be the high end of that particular stock's range. So just using this as a basis, let's quickly go over the Morgan Stanley trade, because this will give us a good apples to apples comparison. So for Morgan Stanley, we basically did the exact same thing we did in Tesla, only we had a little bit wider strike, so we're still playing a directional debit spread in the market. And so for Morgan Stanley, we bought the 30 calls and sold the 33 calls. We paid almost exactly mid price of about $1.50. So if we go over to Morgan Stanley, and let me just type this in here so you guys can see that chart. Oh, yep, there it is, Morgan Stanley. Now you see that that implied volatility is right about the middle part of its range down here below. So there have been times where it's been above, there have been times where it's been below, but Morgan Stanley right now has implied volatility that is exactly at 27.84. So if implied volatility is exactly at 27.84, That's actually dramatically less than Tesla as far as the actual implied volatility factor. So 27.84 versus 65. But when you look at the rank, then you'll notice that Morgan Stanley has implied volatility that actually ranks higher for Morgan Stanley than it does for Tesla. And what this is again meaning is that right now, 27% implied volatility, that is about 37 percentile of its historical range going back a year. So it's almost in the 40th percentile. So that means 60% of the time going back a year, that implied volatility might be higher than it is, and 40% of the time might be lower than it is right now. So again, it's all a matter of perspective. You can't look at the implied volatility of the stock and say Tesla's implied volatility is 60%. That means we have to be selling options. Morgan Stanley is 27. That means we have to be buying options. That doesn't matter. What matters is the rank. Where is that volatility in its historical range for that particular stock? And again, each stock is going to be different. That's why what you'll see when we do this video tutorial and when we do a lot of our video tutorials for our trades is that we actually care more about the IV rank than we do the actual underlying implied volatility. That's obviously important, but IV rank is what we actually go off of. All right, so let's get into some of the other trades that we made. So J&J is Johnson & Johnson. We went in here, implied volatility was really good. So what we did on Friday is we had two directional call trades that we were making, and those we obviously want to stick with. We need a little bit more long delta in our portfolio. Right now, just as a basis, we are pretty much even on both sides. So we actually need to start making some decisions here over the next week on and which side of the market we want to kind of lean towards, or one or the other. We're actually almost exactly neutral with our deltas when they're beta weighted to the SPX. So that's a good thing right now, but it also means that we're really not making too much money in either direction. So we do need to be a little bit more directional in some of our trades. Now for Johnson & Johnson, we went ahead and sold the 190, or we sold the 95, 92.5 put spread. So we took in a credit of 49 cents for that. It was a very small position for Johnson & Johnson, but basically what we wanted to do was take advantage of the move down in the stock, hopefully, or the move up in the stock, and hopefully just this continued move up. It's breaking out into new highs. And you'll notice right now this is a position that we had on Friday, that implied volatility has dropped down to the 50th percentile. So you can see down below, just again, go with this theme throughout the rest of this video, that Johnson & Johnson's implied volatility actual number is 16.34, but that's exactly 50% of its historical range, meaning 50% of the time it's higher, 50% of the time it's lower. Now, it still means you can technically sell some credit spreads here, but you really don't want to get into this territory. You want to kind of be above 50 for sure, so 55, 56, 60, etc. And so what we did is we sold the 95, which puts our first line in the sand, or first short strike at 95. So it gives us a good amount of distance between ourselves and the market. Obviously, the higher the market moves, the more this position becomes profitable. And as volatility drops, this also helps our position as well. The other trade that we made on Friday, our last trade, is we sold a vertical call spread in the Qs. Now, that wasn't really working out for us today, but what we really needed, and the reason that we entered this position, is because we actually needed some negative delta in our portfolio. So we were getting a little bit too positive delta. We were getting a little bit too market bullish. And so we added this, and we also have an IWM call spread. We added the 91 calls for 25 cents, which is actually a really good premium. And had the market gone the other way, this actually would have been a really, really quick profit. But the Qs are starting to move against our position. Implied volatility still seems to be pretty high. It was actually really helpful at the end of the day that the market kind of, retraced away from those highs. So right now, this position is a little bit of a loser here on Monday, but we're still really, really confident in the position. I like the position a lot. And our strikes all the way up at 90, which is up here, give us a lot of room between ourselves and the market. So that first line in the sand right here is at 90, so gives ourselves a little bit of a cushion between ourselves and the market. And obviously, if the market continues to trade sideways and in a range, that's obviously going to be really, really helpful for this position. And we'd like to see implied volatility continue to drop. It's still staying up around 55. right now, so we definitely want that to drop much lower. All right, so let's get to the trades that we made here today. So the first two opening trades that we made were on Cisco and COF. Now, Cisco we haven't actually traded in a little while here. So we actually bought another vertical call in Cisco, and that was the 22.23 call spread. So getting long the market a little bit more here. And we paid just under mid price for that at 49 cents. So that puts our break-even price around 22.50 for Cisco. We'll go to the actual chart here. You'll see implied volatility is not that high in Cisco right now. It's at about the 38th percentile. So up in the top left-hand corner, you can see it's at the 38th percentile. And we're trading basically a directional bet on Cisco with our break-even point right about 22.5. That's exactly where our break-even point is right here on this chart. So since this is a 50-50 bet, we make about 50%, or we make about $50 if Cisco trades higher. We make about or lose about $50 if Cisco trades lower than this at expiration. So we've got a lot of time between now and May expiration for this trade to show a profit. Now, ideally, what's going to happen is that as soon as Cisco trades above this range, and in a significant manner for us to be able to get rid of this position, then we'll actually have the ability to close out the trade at a small profit. Even if, and I've gone over this numerous times in different videos, but even if Cisco trades all the way down lower and just kind of stays down here for pretty much all of April and May, we'll still hold on to this position because at some point we might have an opportunity to take a profit on this trade. And that's really what we're looking for. We're looking for that first opportunity to take a nice, decent profit on that trade, and then we'll just exit the trade. We're not going to hold all these things all the way till expiration. All right, and then the last opening trade that we had here today was a vertical call spread on COF. So this is one on the financials, and you'll notice we are still being very, very neutral in our direction. So we added a position that takes advantage of the market moving higher, and we also added a position that takes advantage of generally the market moving lower by selling a call spread. So in this case, for COF, we sold the 82.5 call spread, and we took in a credit of 53 cents. It's actually a fairly decent credit. So that puts our break-even price at 80.50 for COF, which is definitely above where it's at right now. I'll go to the chart of COF. You guys can take a look at this. And really, the whole idea with this one is that we obviously saw that, Capital One has just been on a huge, huge upward trajectory. And I just don't think it's going to last, right? And so that's my directional assumption. But what I will tell people, and again, this came up in a different coaching session than the one with Tesla, is that if you think, or if you need positive delta in your portfolio, if you think the Capital One is going to move higher, and you just have a different directional assumption than we do, then that means that you don't have to do our trade, but you can go back in and sell a corresponding put spread below the market, right? So if we're selling the call spreads above the market, you go in and you sell the put spreads because you have a different directional assumption. My directional assumption is just that Capital One will maybe likely move down between now and May expiration. Now, do I know what's going on? No. Do you know what's going on? Absolutely not, right? There's a 50-50 bet. Who knows, right? So right now, I need some negative deltas, and I think Capital One is one of those ones that could go down if the overall market goes down. So that's why we sold the call spread. Now, what would a corresponding position look like? So let's go to Capital One just so you guys can take a look at that. As always, in the bottom left-hand corner, you can see our position down below, our short three of the short 80 calls and 3 of the long 82.5 calls. So if you were to make a corresponding trade in this, you would go to a corresponding probability level. So we traded this right around the 30% probability level, which means that our first short strike at 80 has about a 70% chance of being a winner and about a 30% chance of being a loser. That's where we trade ours. And you can see that's also where a vast majority of the option volume was today. Who knows if it was because of our newsletter or whatever the case is, but that's where the vast majority of the trading activity was today. So those options were fairly liquid. Now, if you wanted to do a corresponding option on the bottom side, you would actually go to something that's very similar to a 28% probability. So you probably wouldn't go to the 38, but you would go to about the 72.5 strike puts. That puts your probability about 25%. So that means that you have about a 75% chance of winning, about a 25% chance of losing, and you would sell the 72.5s and you would buy the 70 puts, and you're taking a little bit less credit. You're taking about 40 cents in credit, so you're taking a little bit less credit than we took in, but that also means that you're taking less risk because you have a lower probability of losing on the trade. So lower probability of losing on the trade, the market is going to naturally correct for that. There's no free lunch here, and you're going to take in a smaller credit on the overall trade. So that's a great way to just change up the trade alerts that we send out. So again, it doesn't mean that you guys have to make every trade that we make and you have to match our portfolio exactly. By any stretch, that doesn't mean what we're trying to do. We're trying to teach you guys by sending out these alerts and going through these video tutorials each and every night so you guys understand exactly how we're thinking, right? It doesn't matter when you're selling credit spreads, when you're selling or when you're buying debit spreads, whatever the case is. It doesn't matter what the direction is. What matters is, are you overweight in one side in your portfolio? Do you need positive delta? Do you need more bullish trades? Do you have too many bearish trades? Whatever the case is. What's your overall directional assumption on the stock? Do you think it's going lower, higher, whatever the case is? All that stuff is irrelevant. You can kind of pick and play around, and that's what makes this kind of fun, right? That you can make a directional trade on the market, and the stock does exactly what you think it is. But at the end of the day, the most important thing is, are you trading the right side of implied volatility, and are you choosing the right strategies, right? And that's where we hope that we can come into play by helping out with not only our trade alerts and our tutorials on the website, but also with these videos each and every night. All right, so the last trade I want to go over is the closing trade of GLD. This one is actually could be one of our smallest profits that we've ever had, but it is still a profit nonetheless, basically covered commissions. But we sold back to the market the 125, 124 debit put spread that we originally bought for 53 cents. We sold it back for a whopping gain of $3 per spread. So again, basically paid for commissions. But the overarching idea here with this is that the April expiration cycle is coming to an end. We still have a lot of days. I typed in April instead of GLD. We still have a lot of days between now and expiration, but basically we think that GLD has kind of run its course, right? If I was looking at this stock just new off of the shelf, so I didn't have a short position in it, I basically say, okay, this is a pretty substantial move for the stock right now, and I don't think that we're going to see much lower pricing than here. So at this point, we've held on to this thing for quite a long time, for a very long time holding on to this thing. It's just using up capital in our portfolio that really could be used better elsewhere. So great way to get rid of this trade. Didn't really want to roll it either because, again, I don't keep that directional assumption. I don't think that gold will continue lower. If anything, I think gold and silver are definitely candidates that could continue to move higher. And so we're already long silver, and by getting rid of this, that just kind of redefines the fact that we're long some commodities right now in the precious metals sector. So as always, I hope you guys really enjoyed this video. We've got so much more content coming up. We got so many more video tutorials that I'm working on. The membership, premium membership coaching program has been going great. We're now in our second month of that. Currently, we only have 5 slots available for that premium membership coaching, and we only take 10 people. So as soon as those things are up, then I'll start a waiting list for everybody. But everybody that's on it right now has absolutely loved it. We've got people that are continuing month after month, which only really just speaks to a lot of the personal one-on-one dedication that you're going to get from me to you. So you get my phone number, you can call me during the day, you get super priority email support for your trades, and then we do weekly coaching calls where we go over all of your trades, any trades that we're making. We set up your charts, we set up your trading platform, we make a trading plan for you so that you're ready to go. So if you're interested in that, just let me know or check out our video tutorial about it on the website. Again, 5 spots are left for that right now. As soon as they're all gone, I'm only stopping this at 10 people. I will not take more than 10 people, period, end of story, because I just don't want to overextend myself and not give the high level of service that we're going to give to those people, the high personal dedication that we're going to give to you guys to make this thing very successful. So as always, I hope you guys really enjoy these videos. Please add your comments or questions right below the video. I'll get back to all of those tonight or tomorrow before the open, and happy trading.